My name is Brad Gries. I am a co-head of the Americas for LaSalle Investment Management. I also chair our investment committee in the Americas, as well as sit on the Global Management Committee and run the U.S. transactions team. LaSalle, for those that aren't familiar with us, we're a global real estate investment management company focused solely on real estate with roughly $75 billion in assets under management globally. So when we think about performance, I'd say broadly speaking, we expect real estate to continue performing well on a relative basis, due in part to healthy fundamentals, but also strong liquidity and investor demand in particular, both for current yield and for hard assets. And those factors help support real estate valuations. When you think about breaking down performance by sectors, you got to realize that performance is multidimensional. There's an operating fundamentals component to it. There's also a capital markets influence to it. And those have impact on both cash flows as well as values. And the combination of those cash flows and the valuations produce investment performance. So for those reasons, the performance is not going to be uniform across all sectors. We do expect continued strong performance for the sectors with strong operating fundamentals, such as residential, industrial, and certain niche sectors, for a couple of reasons. First, rents are generally rising rapidly in those sectors, and that has a material impact on cash flow forecasts, which in turn translate into positive valuation impacts and appreciation for those assets. And secondly, those strong fundamentals are fueling really strong investor demand, and that has compressed yields and required returns for those sectors, which further augments pricing and values. And within those favored sectors, I would say industrial's been on a hot streak, red hot, in fact, and we do expect a little bit of a cooling there in terms of its performance, but that's cooling off of about a 30% annualized trailing 12-month return. So even a little cooling, it's still going to perform pretty well. On the other hand, apartments, which fundamentally are quite strong right now, should see some continued improvement. The rent growth there is going to lead to continued acceleration in valuations, and what was roughly a 13% trailing return for apartments is likely to accelerate beyond that. And then conversely, there's some less favored sectors out there, and I think there's going to be some more mixed results due to the same factors, really, in terms of operating fundamentals and capital markets. But they're going to have different impacts for different assets, for different markets, and or different sectors, subtypes. So broadly speaking, I'd say we expect some improvement in the performance for retail, but office is probably going to be lagging. Well, the pandemic has had many effects, but the one I think is most significant is what I call the accelerant factor, which is really the concept that the pandemic fueled trends that were already in place pre-pandemic. And it's a little difficult to separate how much was continued to be driven by the pandemic versus what would have occurred without the pandemic. But the first example of that is in industrial demand. We've all seen a notable increase in demand from e-commerce users. But in addition to that, there's additional warehousing needs for safety stock. And really a broader trend for a lot of companies is modernizing of their supply chains. And all those factors are fueling industrial demand. And I think those are likely to be permanent shifts that are going to have long-lasting impacts on the industrial sector. We've also seen shifts in demand for residential, with really the suburban move being probably most acute there. And I think that was likely to occur anyway, as some of the millennial urban dwelling, growing families sort of grew out of those urban nodes and made the typical historic move to the suburbs. But I think the pandemic really accelerated a lot of those moves, as sort of the urban, high dense living conditions during the pandemic were not ideal for many of those families. So temporarily that left a bit of a void in terms of urban housing demand, but frankly that void's already been backfilled, and the urban residential fundamentals have improved markedly from where they were in the midst of the pandemic. And then I'd say that probably the most lasting impact, and in many ways the most uncertain, is going to be on the office sector. The return to office has been very slow and uneven, while other parts of the economy have recovered, are in recovery, or in some cases even booming. And I think that this reevaluation of office space needs by corporate America, while leases mature and expire over the coming years, is going to remain a headwind for office demand. So as it relates to capital allocations, I would say broadly the real estate asset class has benefited in terms of investor allocations vis-a-vis other asset classes, but allocations can be and are cyclical. And I would actually tell you that the pandemic created its own short capital cycle within the pandemic itself, with real estate and a lot of equities losing investor demand early on in the pandemic as safety prevailed, and then investors started to cycle back into some of the equities that were beaten down and provided good value. And then after that largely recovered, we've seen allocations cycle back into real estate, with frankly 2021 for LaSalle and the Americas being one of our best capital raising years ever. And within real estate, allocations have meaningfully shifted into favored sectors such as industrial, residential, and some of the niche sectors, and away from some of the less favored sectors like traditional office. Inflation is a very hot topic these days, and frankly, a headline fear factor, which is in full force. I'd say our base case for inflation is consistent with many of the central banks, with the belief that the current pressures on costs are really a result of pandemic-driven and very significant supply chain disruptions, but that those disruptions will abate over time. We could see some elements with continued inflation pressure being a little bit more persistent. And then as it relates to the inflation, real estate being an inflation hedge, I would say inflation can be both a positive and a negative for real estate, with on the negative side increasing costs, but on the positive side increasing rents. And I think a good example of that is industrial development, where we have seen meaningful increases in our development costs and our budgets for a lot of our ground up developments. Yet at the same time, we're seeing upward pressure on rents that is more than making up for those costs. And cap rates have fallen due to strong investor demand for the sector. So the investment case for industrial development remains quite compelling, despite the inflationary pressures on costs. And then lastly, as it relates to inflation, I would say that relative to other income producing assets, hard assets, and in particular real estate, are favored by investors when inflation risks are higher, which helps support the valuations underlying real estate. So as it relates to urban versus suburban, we do believe that urban places will continue to recover from the pandemic. And as we look forward, urban places actually could see some annual growth metrics move higher than some of their suburban counterparts. But recently, if you look backwards from 2021, the suburbs were exceptionally strong. And we don't see that the strength of the suburbs reversing, or the growth in the suburbs reversing, but some slowdown is probably expected from what has been a really, really strong 2021. And then in terms of markets, I would say what we've seen recently has been a lot of growth in some of the more affordable Sunbelt markets, like a Phoenix or a Las Vegas or an Atlanta, or even some of the Central and North Florida markets. And these markets are still going to be more affordable. There's not going to be much that will reverse a lot of those migration trends that have already been occurring. But I would say the best markets amongst those are those that are going to be able to offer that affordability component, combined with a productive workforce and an appealing quality of life. And so when you think about those factors, markets like Austin or a Nashville or a Charlotte or a Raleigh-Durham seem to jump out. And those are markets that are high on many investors' lists for investment.